Okay, welcome to the introduction to option trading presentation. Um, Done this, I think the last time I did it was last summer. So again, this is for anybody who is uh, new to trading or new to options, who's just started learning about options. So this is going to be just kind of a basic intro, just explaining what they are, how they work. Um, one of the things with options, at least for me, is my approach to trading in general is keep it simple, right? So you can do very complex things with options, but you can also just do very simple things. So I think one of the things with options, it can be overwhelming to somebody who's just starting to learn it because there's a lot of a lot of lingo, a lot of, they talk about the Greeks, they talk about, stuff like that. And you go, I don't know what that is. Okay, we're going to simplify things today. We're just going to stick to the basics, um, get you to have a decent understanding of what they are, how they work. All right. So uh, this morning I was in the room from 9 to 11. So I know there were at least a handful of you here who were at least there this morning who were saying that they're new to options and we're looking forward to it. So I see a couple names in the attendee list who were here this morning who are looking to learn a little bit. So let's kick it off. So, all right, money management rules. Always got to start trading, right? No matter what you're doing in trading, it all comes down to money management, right? Controlling your risk. So, a couple obvious things. Don't trade with money you can't afford to lose. I mean, I think that goes without saying, although there are plenty of people who do that. Trade with an R that's small enough that it feels insignificant to you if you lose. Now, what I mean by that is the R should be great enough that you do have an emotional attachment to it, but you don't want it so large that if you do lose it, it's going to it might impact you psychologically, right? So your mindset, or it might prevent you from putting food on the table. You don't want that. You want if you're just new to trading or new to options, trade with an R that you're okay losing. Never risk more than 2% of your account any one trade. Now, again, kind of a general rule, just like that your R should be 1% of your account. Make it whatever you want. Doesn't have to be 1%. And I mean, sticking with this rule, never trade more than 2% of your account. That's good because that limits how much you're putting out there at risk. But when it comes to your R, you don't have to stick to 1% of your account. What if you have a $1 million account for whatever reason? You're just learning. Well, don't put up 1%. You have to learn what you're doing. So make that R whatever it is that you are okay losing, but it and it doesn't have an adverse effect on you on your trading. All right, question. Right, so people go options. Well, they're risky, they're complicated. Well, are they? Are they really too complicated or risky for new traders? Cool thing about options is that you have a predefined risk, that every option trade that you take, you know exactly what your potential loss is. And that's pretty cool, right? So if you are getting into a directional option trade, you know that if it's costing you $100 to buy that one contract, let's say, that's your risk. If you lose 100, you lose the 100. So that's a pretty cool thing about options, is that whatever your R is, you can then trade the number of options equal to your R, and your risk is controlled there. They can be very simple to trade. Again, there are extremely complex option strategies out there. When they talk about, the butterflies and the, triple wing dragon, I'm just making stuff up. It's, you don't have to go that route. You can just keep it very simple. And the simplest way to do it are directional long calls or long puts. Okay. Now that also can be a little confusing to some when you go, okay, well, long call, long put. Like if I'm long, how, people think of long as being bullish, right? So some people get confused and go, well, long put, how can we long a put if a put means it's going down? We're going to get into that. Don't worry about it. So knowing how to trade options is obviously key, right? You need to know how to trade them in order to do it. So a long call option, right? So if you're trading, we're just gonna go through some basic stuff. Okay. Definition here. It gives you the right, but not the obligation to buy a specific stock at a fixed price, meaning it's referred to as the strike price. When you talk about options, what you're buying, the price of it is called a strike price. Okay. So allows you to buy a specific stock at a fixed price, the strike price, anytime before a specific expiration date. So the format of an option is there's a strike price, which is the price of the underlying. It also has an expiration, right? And it could be 20 days out, it could be 30, it could be 130, depends. You find that out by looking at the option chain. Okay. The option seller is obligated to sell you the stock at a predetermined price if you choose to exercise the option before the option expiration date. Now, let's again keep things simple. Okay. I've never ever exercised an option. Okay. I've done a lot of option trading in my trading career. I've never exercised an option. That's not what you're doing here. You're not looking to, and what they mean there is if you do actually buy the specific stock at a fixed price, that's called exercising your option. You're not going to do that. You're going to be taking an option, whether it's a call or whether it's put, you're going to be taking it directionally just to make money, and you're going to close it out before expiration. Okay. Especially if you're profitable. Now you do have the choice at expiration. If let's say, if you're at max loss, you can just do nothing and it goes away, right? Nothing's going to happen. Okay. Long call option, max loss and gain. Okay. The maximum loss is predetermined. Again, we know how much it's going to cost us to buy this option, whatever that premium, and we're paying a premium. That's what it's called. You pay a premium for the call option, and that's your max loss. So if that premium that you pay is 100, that's your loss. 300, then your loss is 300. So there is a maximum loss, and it's predefined. So in theory, the maximum gain is unlimited, right? The value of the long call option increases as the price of the underlying stock moves up. So if you buy a long call, meaning call, you think the price is going to go up. If you buy that on Apple and it goes up, let's say they come out with just a world-changing, game-changing product suddenly while you own this, and Apple's price quadruples, right? It goes 10 times, which whatever. You're going to make a lot of money, okay? So the value of that option is going to increase as the price of the underlying stock moves up. So now you go into the opposite, right? You think price is going to go down. A long put option, so puts, you anticipate price going down. So again, they give you the right, but not the obligation to sell a specific stock at a fixed price, that being the strike price anytime before or after or before a specific expiration date. Okay. The option seller, broker, is obligated to buy the stock from you at a predetermined price if you choose to exercise out. Again, nobody's going to be exercising options. Okay. So let's just stick to that's the definition. Great. But we're not going to plan on exercising options. We're just going to buy them directionally and try to make some money. And then we're going to close them out if we're profitable. Or even if we've lost money, as long as we haven't had max loss, we're going to close it out. Okay. But if you are at max loss on your option, you can just do nothing and that option expires worthless and it goes to option heaven. Okay. Long call, long put option, max loss. Again, predefined, just like the long call, right? A long put, it's a predetermined, predefined loss. You know it going into it. This is what's going to cost me to do this. Again, that's the premium. The value of the long put option increases as the price of the underlying stock decreases. So you think Tesla's going to go down. Well, you'll buy puts, right? And that's buying puts is buying, at that point, you're long puts on Tesla. You're expecting price to go down. As price, if you're right and price goes down, the value of those puts are going to increase. So the max profit on this, of course, is achieved if the underlying goes to zero, right? So that's the only difference really between the put and the calls, right? Calls, price can go up to infinity, right? Price can only go to zero, going down. So one slight difference between the two there. Okay, option contracts. Okay, so if you're trading shares, you know that you can buy any number of shares you want. Okay, you can buy one share, you can buy 15 shares, you can buy 100 shares, you can buy any number of shares that you want with the money that you have. Okay, now option contracts. Okay, priced a little bit differently. So one option contract equals 100 shares of the underlying. So what does that mean? Okay, well, if you buy one call option on Apple, that basically gives you control of 100 shares of the underlying. Okay, so buying one option contract, let's say if it is $1.25 per contract, because it's 100 shares, you just add the 2 zeros there, and that would cost you $125 to buy one contract. Okay, so you always want to remember when you're getting into option trading that one option contract is equal to 100 shares. So, okay, why would this be important? Well, as you get further along into your option experience and your trading, so like for instance, for myself, I have a specific strategy where I will utilize naked puts, and then I am also buying shares as price is going down, pyramiding in, building positions. And then once it bounces, then I sell covered calls. Well, I need to make sure that everything I accumulate in terms of shares is all in blocks of 100 ultimately. So as price is going down, I could buy 100 shares, or I could buy 50 at one level and 50 at another level. Regardless, at the end of the day, I want to make sure that the block of shares that I'm holding is divisible by 100. Because if I'm going to then sell covered calls, I need to have 100 shares. Okay. If I'm going to sell 2 contracts, I need 200 shares. So one option contract equals 100 shares of the underlying. Okay. So the underlying asset, it's not just stocks. You can trade options on indexes and futures. Okay. So we'll get into some of the terminology here. And this can, be some of the things that people will get a little confused at, but again, we're going to simplify it. So ITM, acronym for in the money. ATM, at the money. OTM, out of the money. Okay, pretty simple. So ITM, in the money. Okay, that means the call option with a strike price below the price of underlying, or a put option with a strike price above the underlying. Okay, so Tesla, no, just say AMD. Okay, keep it simple. AMD trading at $100. Okay, so your call option would be in the money if you had a $90 strike, because the price would be below 100. If AMD is trading at $100 and your call option is that you have the strike price is 90, well, that's in the money. Conversely, let's say you own AMD at 100, okay, and AMD is now trading at you have a put option on AMD, and AMD's at 100, AMD's at 110, right? Well, the strike price is above the underlying, so that's in the money. We can take a look at if we have time, we'll take a look at the option chain, and then I can further explain that. So at the money, so the strike price for the option is the same price as the underlying. So you're looking to buy a $100 call on AMD, and AMD is trading at 100. So that's at the money. Out of the money, okay, call option with a strike price that is higher than the price of the underlying. Okay. So think about that. Call option with a strike price higher than the price of the underlying. So AMD's at 100, and then you were looking at buying a 125 strike call. That's out of the money, right? Because AMD's not there yet. It needs to go up in order to hit that. Okay. Or conversely, a put option with a strike price that's lower than the price of the underlying. And by the way, if anybody has any questions, please feel free to post it in the chat here. Okay. There's a number of you here who I know are relatively new to this. So if you have questions, please feel free, post your questions. Okay, the option value. So this is where things get a little confusing, right? There's intrinsic value, extrinsic value, okay? So intrinsic value is the in the money portion of the options premium. Okay, well, what does that mean? If the strike price of the option is $35 and the underlying price of the and the underlying stock price is 55, just subtract 35 from 55 and the intrinsic value is $20. So that's what, when people talk about intrinsic and extrinsic, that's how you figure out the intrinsic value, which is just take the price of the underlying, the price of the option, the strike price, and what's the difference? So in this case, it was $20. The extrinsic is the difference between the options price and its intrinsic value. Okay, so in order to figure out the extrinsic value, you need to know what the intrinsic value is, and then it's the difference between that and the option price. Implied volatility, okay? Implied volatility is something that you do want to be aware of, okay? So when implied volatility is high, the option premium increases. And when implied volatility is low, the option premium decreases. Well, why is that important to know? Well, for me, as I focus mainly now on option selling. So I want to sell an option when the implied volatility is high, okay? Because the higher the implied volatility, the more premium there is. And that means, so if I'm selling it, I want to sell when the premium is high, right? If you're going to be trading just calls directionally, okay, whether the puts or options directionally, whether it's calls or puts, ideally you want to, as the buyer, you want to buy the option when the implied volatility is low, because the price of that option, the premium, is going to be lower. Okay, so option contract facts. This is an important thing that you should know. And one of the reasons I went from being a directional option trader to being an option seller. Okay, over 80% of all option contracts expire worthless. Franco was asking, what would be high implied in volatility? So Franco, what you have to do is you have to look at the implied volatility compared to the other strike prices. So again, if we have time, remind me, I'll pull up an option chain and we'll see. But like, it's different for every stock, right? So every underlying, the implied volatility can be different, meaning that so if implied volatility on Apple could be 46% in general, and then Tesla could be 60%, right? It really, you have to look at the option chain. But what you will want to do is, like, if you are looking at so every single month, right, every single expiration for an option, it will tell you what that implied volatility is. So what you're looking for is an outlier. Okay, so if you're looking to buy, let's say if you're looking to buy calls, okay, buy calls on Apple and you notice that the month, and if general, if you're looking at all the option chain on Apple, if you're looking at all the expirations, and if they're all somewhere around like, between 40 and 50% implied volatility, but for whatever reason, the month that you want to buy it is 80%. Well, then you know that the implied volatility is high there, and you're not going to buy that one. You're not going to buy that expiration, right? So you have to look at it in relationship to all the other months. And especially like when earnings roll around, that's when those months will be higher. You know what? Give me a second real quick. Let me just give you an example. We can do this real quick. Okay. If I go in here to, okay, you should see the option chain right now for AMD. Can everybody see that? Just give me one if you're able to. Okay. Yeah, cool. Okay. So look, I'm looking over here. See this over here? That is the implied volatility. Okay. For every single expiration. Okay. You can see that it's all within reason of, every month, it's all between, 40 and 50%, right? There's no major outlier there. Nothing that jumps out as like, wait a minute, why is that so high there? Okay. I'm just looking at various. So again, you look here and go, okay, in relationship to each other, they're all in line. There's nothing that jumps out. Now, look how like here it's like 60, 60s, but there's, and that's not a surprise that it's because it's expiring this, but see how it's 70 here and the rest of them are like 60. Not a great example, but sometimes you see these where it's really out of whack. And then you know that is high implied volatility. So if you're looking to buy that expiration, see over here, this is the option chain. Here's the expiration month. If one of these, let's say, well, and that one just dropped. So let's say they're all around 60, but all of a sudden you look and one of these is like 90. Like one of these months is 90 for some reason. You're going to stay away from that if you're looking to buy. Now, if I'm looking to sell options, then yeah, I want the high implied volatility. Yeah, they're all pretty much in line with each other. But you will notice when you're looking at the option chain, sometimes you'll see one that just stands out, right? For whatever reason. Okay, cool. Let me look. Richard asks, how do the values affect option contract? The values, Richard, give me a little more information. The values of what? You mean the underlying price? I'm not sure if that's what you're asking. When is finally here? Great. Love it. Thanks for joining us. Intrinsic, extrinsic. Intrinsic, extrinsic. Let's go back to that. Those values. Let's go back up here. Okay, so how do they affect the option? Richard, for now, I mean, honestly, like for now, this is just to understand the terms. But for you, like to keep it simple, right? If you're new to this, right? No, it's fine. But if you're new to it, I wouldn't spend a whole lot of time analyzing it. Just, these are just terms that you're going to hear. Like somebody will throw out, well, the intrinsic value, right? Okay, well, what is that? Well, it's just if it's the out of the money portion of the premium, right? So I'm sorry, the in the money ITM. It's the in the money portion of the premium, right? It's not that you really have to know how does that affect the price. It's just like, okay, there's the value is that of the intrinsic value is just, you just need to know that it's the difference between the price of the option and the stock price, the underlying stock price. Okay. Again, you really won't need to know these values to trade directionally if you want to buy a call, buy a put, right? But you might hear these terms, and it would be good to know that, they do exist, and that, it's not going to, it's not going to impact you whether or not you are trading options. You should know that there are these terms that people will throw out, just so you know what they are. Okay. Again, just you won't necessarily need to know that information just to get the basic gist of trading options. Right. Just know that those difference between the stock price and the contract price. Now, implied volatility is so for instance, implied volatility. Just know that there are times when a intrinsic value. Yeah, the intrinsic value right there, when it's the in the money portion of the options premium. Okay. So if the strike price of the option is 35 and the underlying is trading at 55, then that value, the intrinsic value, is $20. So that's how much it has in value, intrinsic value. Yeah. Yep. So, okay. Back to this. This is the important thing. You need to know that 80% of option contracts expire worthless. Okay. Why is that important? Well, it's important just to know that when you're trading options directionally, okay, you need to be right. Because when I mentioned the Greeks before, there is one of these Greeks that you'll need to know that's called theta, which we'll get into, but theta is time decay. And so what I learned when I was, because I went through probably a 2-year period where I was trading options directionally. So I was either just doing long calls, long puts, or I was doing some type of a debit spread. But you need to be right. You need to be right on the direction, and it needs to happen quickly. Okay. That's the most important thing that you need to understand, is that when you're buying options, okay, because 80% of them expire worthless, it's not in your favor to be a buyer, right? It's in your favor to be a seller. Okay. So for this reason, it says right there, sellers of options have a higher probability of profit, right? Which is why I like to stick to selling options. Most buyers overpay. Again, back to the implied volatility. Okay. Most people buying options don't consider the implied volatility. They don't do what we just did and look at the implied volatility and go, okay, is it in line? Is this strike price in line with the other strike prices, or am I overpaying? And if I go back real quick, let's go into, okay. So let's say, if I go back to Tesla, okay. So here, this is just a quick way of looking at the months, right? But let's say if I want to go into this September contract, okay. If I go in here, now I can look at implied volatility, okay, for the individual strike price. So here's all the strike prices, and here's the implied volatility. So again, if I'm buying it, I want to be looking at the actual strike price I'm looking at and making sure that it's in line with all the others, right? That it's not out of the ordinary, that it's not like this crazy number percentage compared to everything else, right? And and of course, the higher you get to, in the money, right, the higher the implied volatility. But like if you were going out of the money and something jumped out at you as a very high implied volatility, then you would want to be aware of that. Okay. Okay. So I already mentioned this. Overpriced options must make a strong move. You can actually, believe it or not, you can have an option. Let's say you buy a call and you buy it and price is moving, right? So let's say you buy a call on Tesla and price is moving up, it's just not doing it quickly, you can actually see yourself, your option value, lose money as the price of Tesla goes up, right? So overpriced options. So if you're buying something with high implied volatility, overpriced options often end up losing money, even though the underlying stock is moving in the right direction. So you really do need to be right on your analysis. And ideally, you want it to move, price to move quickly in your favor. So option probability, buying options. So there's several different things that can happen, okay? If it moves strongly in your favor, you'll be profitable. Great. If it moves slightly in your favor, you might be profitable. No guarantee. So that's what I was saying. Even though you could see price going up, the value of that option may not. Okay. And Franco's saying, yes, that's happened to him. Okay. If it goes sideways or remains flat, you're not going to be profitable due to theta. Okay. So theta was that Greek that I mentioned before. That is time decay. So time decay works against buyers of options, whether it's a call or a put. Theta works in the favor of the sellers. So me as a seller, I like theta. I like time decay because as a seller, the price can actually move and I still can make money, right? So here, it really needs to move in your favor as a buyer, okay? And again, I'm not trying to dissuade anyone here from trading options directionally. No, I mean, there's money to be made. You just need to be aware of the downsides to it, okay? So it does need to move strongly in your favor. If it moves slightly in your favor, you might actually lose money. And if it just goes sideways and remains flat or goes down, right, you're not going to be profitable. So if it moves slightly against you, you're not going to be profitable. So you have a 1 in 4 chance here of making money directionally. And of course, moving strongly against you, you're not going to be profitable, right? So you have a 1 in 5. I said 1 in 4. Option probability, selling options. So now we get into, okay, if I'm selling options, so if it moves strongly in my favor, we'll be favorable, we'll be profitable, okay? Move slightly, we'll be profitable. Go sideways and remains flat, still be profitable. Move slightly against you, be profitable. Okay, if it moves strongly against me, then I will not be, okay? But as a seller, you can see how the odds are stacked in your favor, right? So the only way you're going to lose money as a seller of options if price moves strongly against you, okay? Let me show you. Go to a screen share real quick, different one. Okay. I was looking to sell puts on AMD today, and I was just waiting for a larger candle. I didn't get it. But let's say in theory, right, if I had sold naked puts right down here, right near the low, and it went like that, I probably could have closed them out same day and made good money, right? Because price went strongly in my favor, right? So as I sell naked put, if my put is way down here, I want price to go away from me. And that's exactly what happened here. Could have made some decent money. I was looking to sell it more off down here. I was looking for it to go slightly lower. But so again, for selling options, okay, definitely in your favor. The odds. Wouldn't it be expensive being that close to the strike? Are you talking about my example with AMD? Okay, so I was saying what I was saying was I was actually looking to sell puts today, not buy. So I was actually looking to sell naked puts today. So not buying. So yeah, the closer that you are when you're buying a put or a call, the closer you are to, if you're at the money, in the money, it's gonna be more expensive than out of the money. Okay, the Greeks. I mentioned those before. No, so that's the cool thing about you can basically what you do when you're selling, okay? That's the cool thing about being a seller of options is the only time that you have to own the stock is if you're selling a covered call, okay? Naked, they refer to as a naked put, okay? You can do naked calls too. I don't recommend it, but if you do a naked put, right? What that means is you are selling an option, usually do it, farther away. So let's say, AMD was trading around 107. Like, let's say if I wanted to sell the $90 put on that, right? The cool thing about being the seller is I don't need to own shares. I don't need to own them. They are loaned to me. And then what happens with selling is if I sell a naked put at $90 on AMD, my only risk there is if that closes in the money, meaning that if at the time of expiration, if AMD is at 90 or below 90, I have to buy, meaning the term is I have to cover. I would be put shares. So I have to buy, if it's one contract, I have to buy 100 shares of AMD at 90. Well, I'm okay with that. So I'm not going to get into all the rules around selling right now, but when you're selling options, especially naked puts, when you're selling naked puts, you want to do it on something that you don't mind owning. Okay. There's a whole other presentation to do on selling naked puts, but just so that you know, you don't have to own. The only time that you need to own is if you're selling covered calls, right? It's covered, meaning you own those shares. So how do you get qualified? If you just have to go to your broker, and if you are approved for options, you should be able to sell. So in general, okay, you only have approval. Yeah, I would contact the broker and say, hey, am I approved for selling naked puts? Just ask them and see what they say. It does require, but I think you're in a cash. Are you in a cash account? I remember you making a comment about it today. Because you definitely have to have margin. So, but I would give them a call, see what they say. All right. So the Greeks, okay, you'll hear people talk about the Greeks. Okay. And again, this is just so you know what they are and how they work. So delta, okay. Delta is how much the option will increase or decrease per dollar move of the underlying. Okay. So this changes for every dollar the underlying move. So when you pull up question on naked puts. Okay, I quickly question on naked puts. I want to quickly buy back puts I sold. Yeah. So if you sell puts, okay, were they naked puts? So when you sell puts, naked puts, you sell the open, and then you have to buy to cover. Yeah, I agree, Win. We could do this. We could do this another time. Do like get everybody unmuted so we could do kind of like a full chat thing, right? Live. So Chuck, anyway, question on naked puts. When you are doing naked puts, you sell the open, you buy to close. I don't know if that's helping you or not. Now, if you but when you're trading directionally, you buy to open, you sell to close. Yeah. So in other words, you're saying I don't want to be put when stock. Yeah, Chuck, that's the key thing, right? Is is that's why you only sell naked puts on something you want to own. That's the key thing. Okay. So when you say, I don't want to be put the shares, okay, when it gets low, see, when I do it, I'm okay getting put the shares because I want to. The way I look at it is if I get put the shares in that example I gave AMD, if I get put shares and I have to buy 100 shares of AMD at $90, let's say, well, I got paid to do that. So that's kind of the way I look at it. It's like I'm getting paid to buy something I want to own at a discount. Yeah, I agree with you, Win, for sure. Yeah, what if I'm put shares but the stock is 85? Yeah, so then yeah, so you are put the shares at 90 and you're immediately underwater with it, right? Yeah, you're losing $5. Now, Chuck, okay, one thing to consider, right, is let's say you're put shares at 90, right? And let's say that you and the price of the stock is at 85. You have to factor in the premium you got also. So in your example, you're losing $5, but let's say you collected $2 for that. Well, you're not really losing $5, you're only losing $3, right? So if you do end up getting put shares and the price in this example, your price is below the strike price, so also you got to factor in the premium you collected. Okay, so really at that point, you're in your example, you were saying you're underwater by $5, when really, if let's say, I don't know what you got, but let's say if you got $2 in premium, you're really only underwater by $3, right? So yeah, and that happens, right? But again, that's why it's important to understand that you only do it on the underlying that you want to own. So again, I would be okay owning AMD at 90, right? Okay, so Delta, again, how much the option will increase or decrease with the dollar move. Theta, talked about this, time decay. How much the value of the option will decrease each day if the underlying price remains the same. Okay, again, this also changes with the price of the underlying. The key thing you need to know about theta, okay, and this is a big mistake that new traders make when they're trading options directionally. If you're buying an option, whether it's call or put, and you got to figure out how long it's going to take for it to move. You don't want to be buying, or you don't want to be buying that call or the put unless you're like day trading, but within 30 days of expiration, okay, let's say that you're doing some type of a swing trade, right? And you think it's going to take, I don't know, take a few weeks for this to move. Well, you don't want to be buying the strike price on an expiration that is happening within 30 days. So what I always do is I take, it's a minimum of 30 days, right? So I start with 30 days as my default time frame. Then I factor in, well, how long do I think it's going to take for this to move? Okay. And if I think it's 3 weeks, then I'm looking for an expiration date that's 2 months out. Okay. Ideally, you do not want to be holding onto options if you are trading them directionally. If you are long, meaning you're a buyer of either the call or the put, within 30 days, in that 30 days of expiration, and it accelerates with every day, the closer that you get to expiration, the faster theta time decay accelerates. So you want to give yourself plenty of time. And people make that mistake all the time. They'll go, "Oh, I think Tesla can make this move in the next week or two," and they buy an option that expires within 28 days. The next thing you know, Tesla is moving in their direction, but they're losing money. It's because of theta. Okay, this is an interesting concept, right? Think of options as a penny stock. Well, I don't condone trading penny stocks. I don't think that penny stocks are worthwhile. But what I mean by that, okay, and again, this is an old example. Amazon, had a split, but buying 100 shares of Amazon at the time I did put together this presentation would cost, almost $14,000, right? But you buy one contract at the money of Amazon and it costs you $1,000. So that's what I mean by options allow you to trade any big ticker like a penny stock. So instead of putting up $14,000 to buy shares in this example, you could spend $1,000 and control the same number of shares. Okay. Now, again, you got to keep in mind the value of the option doesn't move dollar for dollar with the move of the underlying, but you go into this knowing that, and you're okay with that because that's the trade-off for not having to pony up 14 grand for 100 shares. Okay. Selecting the expiration date. So kind of already mentioned this, but buying options for a swing trade, use the chart, select a target price, figure out how much time you think it's going to take to hit that, and then add 30 days. So I just gave you that example, right? You look at NVIDIA and you think it's going to make this move and it's going to take a couple weeks, right? 3 weeks. Well, you need to add those 3 weeks immediately to the 30 days and then look for an option that is that far out. Again, you want to use 30 days as kind of your starting point and then figure out from there and add that to the 30 days. Okay. Now, speaking, already touched on buying options for day trade. Okay. So if that should be a single, not a double. On Mondays and Tuesdays, use the current week's expiration. Okay. On Wednesday, Thursday, and Friday, I recommend using the following week's expiration. Well, why? Again, theta, right? So if you go back to our example, let's go back to here, okay? If you go AMD and we look at, so today is Friday, right? So obviously Friday, but any of these options that you would have been trying to trade today would be losing value very quickly because they're expiring today, right? So if you were going to day trade options today, you would use next week's, right? Because theta is already working against you. But if you're trying to trade on a Friday, options that are expiring today, good luck, right? You need to use the following week's expiration. So for today, I would have been using this expiration, the day trade options. So back to my example. Again, this is just the recommendation, okay? On Mondays and Tuesdays, you can use the current week's expiration. On Wednesday, Thursday, Friday, certainly Thursday and Friday, use the following weeks. And you'd sell that today. So what I'm saying is if I were going to, if today, if I were going to be day trading options, just day trading in and out, so when you're day trading, so let me answer Wynn's question. So when I'm saying is you're day trading options, you're not looking to hold that overnight, right? You're just in and out, for a period of time, right? So yes, I would have gotten into, would have gotten in and gotten out the same day, right? So you can do that with options. So Richard, to answer your question, why use closer dates? So because you're not holding them overnight, Richard. So the if you're day trading, theta is still an issue, but it's not as big of an issue as my example I gave. Like if you were trying to day trade options today and you were using today's expiration, well, that's going to hurt you. Theta is really going to hurt you. That's why you use the following weeks. But when you're day trading, you don't have to use 30 days out. Okay. So that's the caveat here is when you're day trading, you can use the current week's expiration or the following weeks. Because the farther out you go, the more you're going to pay. And there's no reason because you're not looking to hold this overnight. You're just trading them in and out. So you wouldn't have to go any farther out than the current week, or the farthest out would be the following week. You certainly don't need to go, you wouldn't go 30 days out, because now you're overpaying for, you're basically buying time decay at that point, right? You're paying for more time. Yeah. So when saying, so in other words, swing trading for bigger profit, you're day trading for a quick profit. Yep, exactly. Right. You're either looking to hold for a longer time frame, bigger money, or you are just in and out quickly, just trying to make the quick money. Okay. So selling options. When I sell options, I'll sometimes go 2 months out, depends, 60 days, but ideally sell options with 40 days or less to expiry. Okay. Ideally 30 days or less. Again, why? Because of theta. Because theta works in your favor as a seller. So when you're buying options, start with 30 days as your default time frame, and then figure out how much time you need to add for the move to happen. If you're selling options, try to sell it as quickly to the current date as possible. Okay. Delta, open interest, implied volatility in the spread. Okay. So these are just my general rules. Okay. Delta, again, delta is how much it's going to move with, how much that the value of that option is going to move with every dollar movement of the underlying. Okay. So delta, I don't go any lower than 20 cents. Okay. And not greater than 70. So I don't know. What does that mean? Again, no reason we can't just go into some live examples. Okay. So if I'm looking at, let's say I'm looking, would theta be better selling an option 2 weeks out or 1 week out? So theta is going to work better in your favor 1 week out, 2 weeks out. Franco, really, if as a seller of option, anytime within a 40-day window, you're good, right? Ideally 30 days or less. But 1 week out, theta is going to be much farther along and more accelerated than 2 weeks out, right? So the closer you get to expiration, right, that's when theta accelerates. Okay, so let's look at these examples. I was just talking about delta. Okay, if you look here, okay, so we're on AMD, and if I was going to do like a 110 call, okay, so here's your delta, right? It's going to move 50 right now. It's going to move 55 cents for every dollar move that AMD makes. Okay. And again, that changes as the price changes. But what I just said is my minimum delta is 20 cents. So if I'm going to go out of the money, meaning here's at the money, in the money, at the money, right here, way in the money, out of the money, down here. So out of the money, if, we're currently like right around 110, out of the money would be going down here. Well, if I just look at delta, I know that the farthest out that I can go based on my option buying rules is 130, right? Because that's an option, that's a delta of 23, right? When you start getting farther out of the money here, if you look here, it actually will show you probability of in the money, right? So this is, again, these are just probabilities. So probability of it closing in the money. So at 23, you've got a 17, almost 18% chance, right? You get down to 18 and it drops. You get down to 14 cent delta and it's way down there, right? So just know that it's a pretty good rule of thumb that I follow, which is I won't go any farther out of the money than 23 cents. And in my opinion, there's no reason to go farther in the money than like 70 cents. So either the 74 or the 65, right? Right in here. Right. Okay. So open interest. That's another key thing. Open interest. Go back to this. If you look right here, open interest. Okay. It is exactly what it sounds like. How many people are interested in this? So My rule of thumb is there needs to be a minimum of 100. Okay. So when you look down here, right, just use this as just a gauge, like where are people putting their money? Like where do people think, right? And so, if you go down here, there is none right here that's lower than 100, but sometimes you'll see open interest of less than 100. So for me, there has to be a minimum of 100. But you can also look at these numbers and kind of use that as a gauge of, where people think AMD might go. Like, look, I mean, there's, we were looking at this 23 delta here that has, almost, 16,500 open interest. But then you go to this 14 farther out of the money. There's a lot of people here, right? A lot of contracts sitting there, 24,300, right? But again, my rule is I won't go any lower than a 20 cent delta. Okay. Implied volatility, expected move. Okay. This is, you talk about the current implied volatility versus historical and the market maker's expected move. So again, you have the implied volatility. Again, these, like, good to know, but you don't have to. The key things that I'm looking at when I'm looking at the option is I want to know theta, delta, open interest. Those are the things I look at. Right. So I want to make sure there's enough interest in this strike price. I want to make sure that the delta is 20 cents or greater. And theta, I want to know, okay, how much is this going to lose in value every day? Right. And again, that can change. Right. So right now it's losing 8 cents a day. Right. As it goes farther in the money, it loses less. And so anyway, those are the ones that I look at: theta, delta, open interest. Again, you as a buyer, okay, again, as a buyer, you do want to pay attention to the implied volatility, in the sense that you want to make sure that you're not buying something with a implied volatility that is way out of line with everything else. It's not times, so if the value of this if you're buying this for like the mark on this, let's just say is, $8.58, right? The value of that is going to drop by 8 cents. But yeah, you could look at that times 100, right? Because this is going to cost you $855 if you want to do it that way. And then, it's going to drop by what? $8, right? So you could look at it that way as well. Because one contract is 100 shares. Okay. Bid-ask spread. Okay. Just like when you're trading, shares, right? You should always be aware of what the bid-ask spread is. So bid-ask spread, I look for 30 cents or less, right? When we're talking options. So here's the bid, here's the ask, right? Pretty tight, 10 cents apart, not bad. I always buy, so I always try to get filled somewhere in the middle, right? So if I'm looking to get into an option, I'm not going to pay, I'm not going to pay the ask. Probably won't get filled a bit. So I'm going to go right in the middle. Okay. So the mark is the midpoint. So sometimes when you're at your broker, like I think Interactive Brokers might have midpoint, but here mark is the middle point between the two. So I just pay attention. Most of these are going to have tighter bid-ask spreads, just like with shares. Like Tesla's going to have a wider bid-ask spread on its options. All right, did we get through it? We did. That was quicker than I thought. All right, that was the last slide. All right, so let's take this time. We have like 30 minutes, right? So let's take a look at some of these option chains, okay? So let's look at this question. If I buy 100 shares at $25, I sell a weekly covered call at 28 strike. Yep. I get my shares called away. Is that a win? Well, yeah. So what happens, Richard, is let's say you buy 100 shares. Okay. You buy 100 shares at $25. And then you sell the covered call at 28. Well, a couple things. You're gonna keep whatever premium you receive for that, right? So whatever you were paid to do that, plus you're going to keep the profit from $25 to $28. So yeah, that's a win, right? It's profitable. So it just depends on what what you received in order to do that, the premium you were paid, and then you also are able to then keep the profit between 25 and 28. That makes sense? All right. Give me a second. Since we have the time, we have like 20 something minutes remaining. I thought there were more, I wasn't really paying attention to the number of slides. I thought we had more, but that's it. That's the basics of options. Okay. So since we have the time, let me stop the share. I'm gonna pull something up for you. I'm gonna give you insight into one of my favorite strategies that is actually now couldn't use this in the bear market that we were in, but now that everything is looking to go bullish, it's back to being a viable strategy. So let me pull up an example. Give me 1 minute. Just bear with me. Just give me a minute. I'm just pulling up an example. Trying to find a good one for you. Something that didn't require a lot of capital. Okay. All right. Let me go to DraftKings. So I need to go back in time. This can be like time travel. Let me get this set up and then I'll share the screen. So we want to go from yeah, we're going to do the time warp. Absolutely. This is you'll all get a free ride in my time machine. Let me see if I did this right. Ah, brilliant. Okay. Let me pop this out. Okay. All right. Can everybody see this chart right here of DraftKings? Give me a 1. Okay. So you all are going to get the benefit of this extra 20 minutes that I now have to fill, time with, right? So presentation did not run as long as I thought it might. I thought it would take us all the way to 5. So now you get the benefit of seeing something that I teach in my mentorship groups that I've never shown in the all access room. So hold on. This is a good one. Okay. So this is a strategy that I use to create monthly income. Again, this is a bull trend strategy. You cannot use this. It does not work in a bearish trend. But now that we've broken out the broader markets and everything else, now that we have broken out of the bear trend that we were in for the better part of the year, things are moving nicely bullish. Okay. So DraftKings. Okay. The example I'm giving you here was COVID, right? So think about this. We're all at home. We're all sitting at home. We are quarantined. We're not out. We're not, going to restaurants. We're eating in. We're, all that good stuff that we experience. Okay. So you can see this, right? Just want to make sure you've got my screen of that here of DraftKings. You did give me 1, right? You saw everyone can see this. Yeah. Okay. It's cool. All right. Here's the thing. Okay. When something is trending, okay. Now we're not seeing the full, length here. We're only seeing, but at the time, this was trending bullish. We were in a very nice upward bullish trend. Okay. So DraftKings, it made this move up here. Okay. And then again, what you're not seeing is the price action down here, which was also very bullish, right? So very key point here. You got to be in a bullish trend for this to work. Okay. So bullish trend. Okay. Price comes up here, makes a new high. Okay. There's a whole other presentation here on selling naked puts, but I'll just touch on the key things. You never want to sell the naked put on the first big red candle after a high, right? So that's not the candle that you do it on. Okay. So, I actually had lost sight of DraftKings. I really should have sold it on here, but it still worked out for me. So what I ended up doing, okay, was on this day here, which was 10/20. Okay. I sold to open. So when you are a seller of options, you sell to open. So I sold to open 2 naked puts on DraftKings right here. Price at that time was $42 roughly. I sold a $30 strike. So down here. Okay. $30 strike down here. And I sold 2 of those for $1.45. And the expiration was 2 months out. Okay. So again, I prefer to be within 40 days, but in this case, it went 2 months out. So immediately when you sell, the money goes right in your broker. So immediately I collected $290. That got into my broker, right? It's not huge money, but keep in mind, this strategy is all about base hits. It's not about hitting home runs. Okay. It's about base hits. So sold to open 2 naked puts here. Now I already had levels where I wanted to buy. Okay. So my first level where I wanted to buy was down off of this down here. So right around this 40.75, I think was my level. So I sold naked puts here. I had a limit buy set up down here. So on this day, right, my thesis was already that DraftKings was going to go down. So I decided instead of waiting for it to go down here to buy my shares, I just decided to day trade this down. So that's what I did. So I started off by, because if you think about this, at one point this opened here and it traded all the way down here, right? So at one point, so I decided I was just going to short shares down to the level where I wanted to buy. Okay. So I shorted 200 shares at 42.35. So 42.35, somewhere around that area right here. And then I covered those short shares as it went down to my limit buy. So I initially I bought 100 shares. That put that was a $73 profit. Then I meant to cover, I probably realized it, I meant to cover another 100 shares, and for some reason I covered 200. But anyway, the profit went this way. I made $73 on one, getting out of one, and then 89 on another. Again, not huge numbers. That's not the important thing here. Important thing is the total at the end. Okay. Then right down here, I did finally buy 100 shares. So I bought 100 shares right at this level. So I shorted down to it, bought 100 shares. Now, again, I'm trying to build a position. I wanted to own the shares, right? So I'm trying to leg in. But as soon as I bought them like right down at the bottom here, like literally right 40.75. So right at the bottom of the day. And then it went up. Now, I'd intended of buying and holding, but then it went up. So at the end of the day, I was like, well, that's a gift from the God. So I closed out that position and I closed out that profit for $120. Thinking, okay, again, keep in mind, the key thing is I wanted to own shares here at 40.75. Then the reason I closed this out was, well, if it gets back down there, I can always buy again, right? So why not just take that profit? I had different levels where I was looking to buy down here. So then I also concluded that, well, if it comes back down here, I'm not going to buy at 40.75 again, because if it breaks this hammer, it's going lower. So then on the 28th, which was right here, I bought 100 shares. I had another limit buy set up. I bought 100 shares. And again, I happened to buy right at the low here, and then it went up. So I sold it again. Again, I'm not intending to do this, but just the way that the price action worked out, I meant to buy and hold, but then I happened to buy right at the low. So then it went up. I collected another 200 in profit. Then on the 30th, which was right here, I had and again, same concept. I decided, okay, well, I'm going to lock in profit. It's like a gift from the trading gods. If it breaks this low of this, it's going to go even lower. Sure enough, it did. So then on the 30th, which was here, okay, I intended on accumulating several hundred shares of this. It just so happened that every time I bought low, price went up. So I just locked in profit. So on this day here on the 30th, I bought another 100 shares. Okay. So now I own 100 shares. Okay. Think about this. Throughout that whole process, I had intended on accumulating several hundred shares. And at that point, I had only acquired 100, just the way things worked out. So I acquired 100 shares on the 30th here. Then it comes down here and it starts to bounce. So on the 3rd, right here, okay, I sold the open one covered call because I only had 100 shares. After all this buying and selling, I only ended up with 100 shares. But keep in mind, I still have my $30 naked puts down here. That would be 200 more shares, but never got there. So on this day, I sold a covered call, and I sold that for, let's see, I sold a $40 strike. So Richard, I think it was you who asked that question, like $25 to 28. Well, think about this. I sold this and I just sold a $40 strike. Because again, I know part of it was I had wanted to end up with like 400 or 500 shares throughout this move. And I only ended up with 100, which is fine because the rest of it was all profit. So on this day, when I sold the covered call, I'm like, well, it's only 100 shares, right? I can sell a $40 strike price, right? So $40 up here. And if I get called away, I'm still collecting the premium that I got, which was $2.50. So $250 on that for one covered call. And then I also get to keep the profit. So at that point, my price was like 36. So I would keep the $4 profit up to 40, right? So that's what happened. And then, and it kept going up. And then I got called away somewhere up in here, right? So I gave up some profit, but that was fine. So in the end, let me bring this spreadsheet up to you, bring it into view, so you can see exactly what I just talked about. Okay. Everyone can see the spreadsheet. Give me a 1 if that is in view now. Part of it. Just, you should be able to see this, right? Yeah. Okay. So let's run through this real quick because I know I gave you a lot of numbers so you couldn't see it. But on the 20th, right here, sold to open 2 naked puts for $1.45 each, $145, $290 profit immediately went into my account. Okay. Credited. Selling the 30 way down here. Do I want to own DraftKings after it was up at 64 at 30? You bet I do. And get paid for it. Sure. I'm good with that. Getting paid to own this at a discount after it just hit 64, getting it 30 if I had to, 50% off. Yeah, I'll take it. So 145 bucks times 2, 90, right? Then this was the day that I said, okay, well, I have a limit buy set up here. I'm just going to short it down to that level, cover it, and then buy my 100 shares. Well, I shorted, I covered, and then it bounced. So here I sold 200 shares. I covered part of that, covered the rest, went, and that this cover, right? These two together equals 300. So that means I, cover more than I had, right? So, but then on the 22nd, which was right here. I'm sorry, that was on the 21st. Oh, 21st. I guess that was here. Okay, the 21st. I get it. Okay, it didn't go all the way down to my level where I was looking to buy. So that was just a day trade on the 21st right here. Then on the 22nd, that's when I bought. Okay, that's when I bought right off the low on the 22nd. That was right here. And it immediately bounced. So I bought it intending to hold those 100 shares, but it bounced and it went. So I bought it at 37.84 and it went up $2. So I covered it. Why not? I still wanted to buy. So on the 30th, which was here, that's when I bought another 100 shares at 36.05. So throughout this whole process now, I only have 100 shares. Then on this day, I sold a covered call, right? Collected $2.50 or 250 bucks. Then on 11/17, right here, I decided, okay, this strategy, I mean, normally I end up with several hundred shares. Didn't happen on this particular one. Doesn't matter because you'll understand in a second. I bought to close. So up here, all these are color coded. So each of these colors tie in the transactions together. So on here, I sold to open. On that lime green, on this lime green, I bought to close. And it cost me basically 10 bucks a contract. Right. So right here, $20. So it cost me $20 to buy to close it because I didn't, at this point, I was just moving on. And then I got called away on my shares. Okay. So right here, I got called away at the $40 strike. This column, profit loss. Okay. Oh, so what it means when you get called away. So when you sell a covered call, if at expiration, if the strike price is in the money, then that means that you have to give up your shares. Okay. You get called away, meaning I had 100 shares, right? And I sold a $40 strike, but at the time that at expiration is up here at 48. So at that point, I get called away, meaning the broker takes my shares away from me. Yeah, separates me from my shares, right? Chuck, I'll post the recording in Slack. Not a problem. So here's the important thing, right? Look at this column. Profit loss. Okay. Down here, basically $1,400. Again, the key thing here is you don't see any big home run hits, right? These are all small wins, right? But a series of them. 1,400 bucks profit. Look at this. In total, it only tied up $3,600 of capital. My total return in 1 month was 39%. Right? That's the cool thing about this strategy is it doesn't require a lot of capital. right? Doesn't require a lot of money to make that happen. Total capital of $3,600, and I made 39% return in 1 month. That was my profit, right? And I only had, at one point, I only had 100 shares. The most shares I ever had that I held on to was 100. When says, how often does that exact situation work out happening? Well, here's one I did on Penn. Profit loss, basically 2,300. Okay. Total capital, 11,000 and change, 20% in 24 days. Here was Pins, $1,800, almost $1,900 profit, 25% return. Total capital was just over $7,000. It's a great strategy. Right here, profit loss, 1,100, total return, 21%, total capital, a little over $5,000. Yeah, win. It's a great strategy. Again, the key thing you need to understand is it only works in a trending market, bull trend, right? You can't do this in a bearish trend. I would have gone bankrupt 10 times over if I tried to do this in a bear market. But it works great in a bullish trend. And if you look here, let me get rid of this. Let me go now. I'll show you the ones that I'm watching right now that I'm looking at on this, right? AMD. Oh, I need to go to today. Okay. That's why I have this on here right now. So right here. Sorry. So AMD, right? We can all agree is now in an uptrend. It broke here, right? It's making higher highs and higher lows. And look at this move. Boom. So I'm doing the strategy right now on AMD. This is exactly what I'm looking for. Strong. First of all, it's been in, ever since we broke that bear market, it's been in a bullish uptrend. We come up here, and now I've got my levels where I'm looking to buy and remove some of these lines. I actually didn't here. I was waiting for today to see if I could get a big down day. That's what I was, when I said earlier, I was looking to sell puts. That's what I was trying to do here, right? Really could have done it on this day. And this was the day that Lauren sold his puts. He beat me to it. He got him on this day. But I'm thinking, I was looking for today to be a bigger down day, and I could have sold them on here. But AMD setting up, right? DraftKings, right? Passes prologue. Oh, Robert Thompson's here. Okay. Robert, give me I got 2 minutes. Let me just show you this one. Same thing, DraftKings, right? Strategy worked before, great on DraftKings. Well, now look, we're in this, this bullish uptrend, right? So all I need is for it to come down here, make a big retracement. I'm going to start selling the puts. I'll start legging in on different levels. I skip parts of the strategy just because it's, try to explain the whole thing is in 20 minutes is difficult, but utilizing the fibs in order to do this is part of it. So DraftKings is one that I'm watching. Net, same thing, right? Nice move, double top, looking for that pullback, right? So see this kind of shaded drawing. I'll move this over now. That's the candle I'm looking for. I drew this out. I'm looking for this level right here to get broken with a big bearish candle. And that's when I will initiate the strategy by selling puts. And then I'll have my levels identified where I'm going to start legging in, pyramiding in and building the position. So, all right, time for me to wrap up. Robert Thompson is here. Hope everyone enjoyed the presentation. Let me go ahead and stop the recording.